One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. You know what it is. My name is Alex Mason. I am your host, recording live from Ithaca, New York. Hope you're having an amazing day. Let's go ahead and get into today's topic. We're talking about deferred tax liabilities, digging deep on this topic. And today's question is this: how do you account for deferred tax liabilities in forward projections in a merger model? How do you account for deferred tax liabilities in forward projections in a merger model? And we've talked a lot recently about deferred tax liabilities, so you should be no stranger to this subject by now. These are liabilities created on the balance sheet during an M&A deal where there are asset write-ups during the transaction. And when these write-ups occur, the amount of the write-up multiplied by the tax rate gives us the amount of the deferred tax liability. So we've covered that a couple episodes ago, so you understand the definition. But really, how do we answer this question? How do we account for DTLs in a merger model? Well, recall that the purpose of any model, whether it's an LBO model, a standard DCF model, M&A model, etc., the purpose is to create forward projections to get a sense of what's likely to happen financially with the target corporation, whatever business we're analyzing, or in the case of a merger model, multiple businesses, we're trying to understand how future finances are going to be affected. So there's a few steps here to consider when looking at the future effects of deferred tax liabilities. So the first thing that we want to do is project out the book values of the company's assets and liabilities. We want to project out the financials. And then we want to compare those projections to the taxes that will have had to be paid in the future based on those book values. So if you have certain values of an asset, for example, let's say they increase over time, then how much taxes are likely to be owed? Okay. So now what you're looking for is the amount of tax the company is going to have to pay in the future based on its pre-tax income. So kind of like your standard amount of tax that is technically owed based on these pre-tax income, which in turn is derived from what the book values are on the balance sheet, because they all interact with each other in terms of balance sheet and income statement. So that's one part. Next, look at the actual taxes that the corporation is likely to pay based on various adjustments. And these are adjustments that we've been talking about for some time, with asset write-ups being one of them. So with asset write-ups, you know you're going to have to pay different amounts of taxes in reality, because now all of a sudden it's like, okay, the value of this has changed. Therefore, we're going to need to pay some different amount of taxes in the future, either more or less. So consider also things like net operating losses that may lower a company's tax burden. That's going to lower the actual amounts of taxes that a corporation has to pay, right? As opposed to what's on the book value. So if a company has a certain level of pre-tax income, but at the bottom line of the income statement, it's operating at a loss, it's going to have a net operating loss, right? Which might be carried forward into future years. And those previous years of net operating losses in your future year projections are going to impact the actual amount of taxes that the company is going to have to pay. So there's basically two different sets of numbers that we're looking at. Number one, we're looking at the future taxes it looks like the company should pay based on its pre-tax income. And then number two, we're looking at the future taxes it looks like the company will really pay based on net operating losses and based on amortization and depreciation expenses, which would come from your asset write-ups. So let's call the former set of numbers your book tax expense and the latter your cash tax expense. Book tax expense is what it looks like the company will pay in taxes based on the book values of its assets and liabilities and its pre-tax income ultimately. Cash tax expense is what it looks like the company will pay in taxes based on the adjustments that have to be made from write-ups, write-downs, and net operating losses. So if the cash tax expenses are higher than the book tax expenses, what does that mean? That means the company's paying out more money than what it looks like they would owe on their books. And so as a result, you would decrease the DTL on the company's balance sheet, your deferred tax liability. Now, why does this make sense? This makes sense because if you're paying more than what's owed on the books, the corresponding liability must decrease. Think about if you have a car payment and you have a certain balance owed on your car. Now you have a payment that's owed every month, but if you pay extra on that payment, what's going to happen to the liability on your balance sheet? It's going to decrease, right? You're going to decrease that level of debt. It's a similar principle, similar concept here. Now, conversely, what happens if the cash tax expenses are lower than the book tax expenses? Well, the opposite happens. You increase your deferred tax liability on the company's balance sheet. And the reason that this makes sense is because if the company isn't actually paying as much as the book values would indicate, the company is going to have to pay more taxes at a future date. And because we're going to have to pay more taxes at a future date, that's a definition of a liability, right? That's an obligation of future cash flow, which increases the deferred tax liability on the balance sheet. And so those are your differences between these tax expenses, cash tax expenses, and these book tax expenses, and why the differences between the two impacts how much the deferred tax liability is going to change in either direction, either up or down. Okay, so that's what I got for you today here on Investment Banking Insights. Go out and have an incredible day. I'll see you next time.